Hey everyone, the OG John here. What hit across my desk moments ago has taken my sleep away. It is not really about silver this time, but something that even I wasn't prepared for. And I think every single one of you out there should hear about this. Stop watching the chart. Stop listening to analysts celebrating the dollar's supposed victory. And definitely stop panicking because silver briefly touched $83. Because while you were staring at red candles in New York, the real move, the checkmate move that will define the next decade of global finance, just became official policy in Beijing. The United States thinks it won yesterday by smashing prices. China just published the blueprint for winning the war. And the mechanism they're exploiting, a $34 arbitrage gap that functions like a financial black hole, is draining Western vaults at a rate that makes yesterday's price crash look like a strategic catastrophe rather than a tactical victory. It's February 3rd, 2026, and the most important development today isn't the price of gold. It's an article just published in Qiushi, the flagship theoretical journal of the Chinese Communist Party. This isn't a blog post. This isn't market commentary. This is the official voice of President Xi Jinping himself, and he didn't write this article to discuss philosophy or economic theory. He wrote it to issue marching orders to the People's Bank of China. He wrote it to declare the start of what he explicitly calls the financial military parade. The article's title is Building a Financial Power, and the Chinese version, which differs significantly from sanitized English translations, lays out China's endgame strategy in remarkable detail, 6 core tasks for achieving financial power, and positioned as the absolute top priority, above all others, is building a powerful currency. But here's where it gets specific. Xi Jinping explicitly states that the prerequisite for having a powerful currency is gaining pricing power of gold, becoming the #1 producer, consumer, and importer of gold in the world, and possessing the world's largest gold reserves. Not second largest, not competitive reserves, the largest. This isn't speculation. This is documented Chinese government policy written by Xi Jinping and published on the official government website. Gold pricing power equals currency strength. And the pathway to gold pricing power runs through production dominance, consumption dominance, import dominance, and reserve accumulation on a scale that dwarfs all competitors. The article then states something that should terrify monetary strategists in Washington. China is close to completing preparation. Its huge gold reserves, the real reserves, not the reported figures, will support the internationalization of the renminbi, and the global gold final battle is about to break out. Those are China's words, not mine. The global gold final battle. They're not hiding their intentions anymore. They're declaring them openly. Gold will define the value of all national currencies and establish the new international financial and monetary order, and China is positioning itself as the dominant player in that battle. Now let's talk about timing. Why publish this now? Why release this explicit policy statement less than 24 hours after U.S. banks executed a massive paper dump that drove silver to $83 and gold below $4,700? The timing isn't coincidental. Beijing knows the U.S. is vulnerable. They know that paper smash was a desperate attempt to defend dollar credibility. So they're countering it with a weapon the U.S. cannot defend against. The truth about their strategy and the reality of physical accumulation that's been occurring in secret for years. Intelligence flowing out of Shanghai's financial district suggests this Qiushi article is the precursor to something far larger. Credible sources are reporting that China is preparing to officially update its gold reserve numbers. For years, the official figure has been a transparent fiction. They report adding perhaps 27 tons annually through modest monthly purchases. But analysts who track actual physical flows, import data through Hong Kong, domestic mine production, and warehouse movements, estimate the real accumulation is 10 times higher. They've been hiding thousands of tons in off-balance sheet accounts under the State Administration of Foreign Exchange and possibly military holdings, accumulating in shadows, waiting for the optimal moment to reveal their position. And according to Xi Jinping's article, that moment is approaching. Imagine the scenario: U.S. markets already stressed, debt at $38 trillion and climbing, confidence shaken by volatility, and suddenly China holds a press conference. They don't deploy military assets, they don't issue threats, they simply update a spreadsheet. They announce that instead of 2,300 tons of gold, they actually hold 30,000 tons, or 20,000, or even 15,000. Any number substantially above market expectations would have the same effect. They announce that the renminbi is now backed by more physical gold than any currency in modern history. What happens to the US dollar in that moment? What happens to the price of gold? The repricing would be instantaneous and violent. Gold wouldn't gradually rise from 4,900 to 6,000. It would gap up overnight because markets would suddenly understand that prices have been suppressed by entities with paper claims while value has been hoarded by entities with physical metal. This is what Xi Jinping means by the financial military parade. Just as China displays hypersonic missiles in Tiananmen Square to demonstrate military capability, The gold reserve reveal is designed to demonstrate financial sovereignty. It's a message to Washington. You can manipulate paper prices indefinitely. We have the physical metal. Your move. And here's the profound irony. The U.S. accidentally helped them execute this strategy. By smashing prices yesterday, by creating that crash to $83, U.S. banks made gold and silver cheaper for China to acquire. They put strategic assets on clearance sale right before the reveal. China is leveraging that gift, taking every ounce that flows out of London and New York, using it to build the foundation of the powerful currency Xi Jinping just ordered into existence. But there's a specific mechanism driving this flow, a mathematical reality that explains why Western vaults are bleeding at accelerating rates. We need to talk about David Jensen's analysis. We need to understand the $34 arbitrage gap that's functioning like a vacuum cleaner for global silver. David Jensen is one of the few analysts tracking the actual plumbing of the silver market, not paper contract volume, physical bar movement, actual metal flowing through refineries, vaults, and shipping routes, and he's identified something that should be flashing red on every trading desk in London and New York. A vacuum so powerful it's sucking physical inventory out of the West at rates that are mathematically unsustainable. The Shanghai arbitrage. Right now, silver on the Shanghai Gold Exchange trades at a massive premium over London and New York prices. The paper smash drove Western prices to the mid-80s, but in China, the price barely moved. The premium, the additional amount Chinese buyers pay just to secure physical metal, is currently around 29%. That's approximately $23 per ounce above Western spot. But the real number is even more dramatic. To import silver into China, you must pay the value-added tax when the metal crosses the border. China's VAT is 13%. When you add that 13% tax to the 29% premium, the replacement cost, the actual price commanded by silver inside Chinese borders, becomes staggering. It's trading at $36 above Western prices. $36. That's not noise. That's a chasm. Now consider logistics. How much does it cost to ship silver from London to Shanghai? You need secure armored transport, insurance, air freight for fast delivery. The total cost is roughly $2 per ounce, maybe $2.50 for expedited service. Do the math. Profit equals the spread minus shipping cost. $36 minus $2. That leaves $34 of risk-free profit for every single ounce you move from west to east. $34. In financial markets, this is called an infinite money glitch, free money. If you're a bullion bank, a trading house, a mining company, why would you sell silver in New York for $86 when you can load it on a plane, fly it to Shanghai, and sell it for $120? You make an instant 40% return on a 12-hour flight. There is no better trade available anywhere in global markets right now. This is the vacuum. This is why metal is hemorrhaging from Western vaults. Water flows downhill, capital flows to highest returns, and silver flows to the highest bidder. Right now, China is the highest bidder by a massive margin. They're effectively paying a $34 bounty on every ounce of silver in the world. Bring it to us. Drain your vaults. Empty your ETFs. We'll pay premium prices. And Western banks are taking the offer. They're arbitrageurs. They don't prioritize national security over quarterly profits. So they're draining LBMA vaults in London, draining COMEX vaults in New York, stripping the West of its strategic industrial stockpile to capture that spread. Every day this premium exists, thousands of bars leave the dollar ecosystem and enter the renminbi ecosystem. And once silver crosses into China, it never returns. China doesn't export silver. They're a black hole for metal. It enters and stays to build solar panels, electronics, military systems, and the powerful currency Xi Jinping ordered. This is why yesterday's paper smash was a catastrophic strategic error. By driving the U.S. price to $83, they made the arbitrage wider. They made it more profitable to ship metal east. They effectively subsidized Chinese accumulation. They thought they were defending the dollar by painting scary charts. In reality, they were putting their own strategic inventory on clearance sale for their primary geopolitical rival. The U.S. government knows this. They're not blind. They have intelligence. They can track cargo planes. They understand that if this vacuum continues for another month, registered silver and COMEX will hit zero. They're facing potential physical default, and that's why panic is spreading through Washington. That's why Secretary of State Marco Rubio is hosting an emergency meeting tomorrow, February 4th, 2026, the inaugural Critical Minerals Ministerial in Washington. He summoned ambassadors and trade ministers from Europe, Japan, South Korea, Canada, and Australia. The official press release states the goal is strengthening and diversifying critical mineral supply chains to ensure economic resilience. That's diplomatic code. Translation: China is taking everything. Help us. They're trying to form a NATO for metals, a Pax-Silica alliance to stop the Chinese vacuum from consuming the remaining resources of the Western coalition, because they've seen the same data Jensen analyzed. They see the $34 gap, And they understand that silver isn't just monetary metal anymore. It's the new oil, the strategic resource of the 21st century. You cannot execute the green energy transition without silver. Solar panels require it. You cannot advance artificial intelligence without silver. High-end chips need silver interconnects. You cannot maintain modern military capability without silver. Every Tomahawk missile, every F-35, every satellite system uses significant amounts, and the United States consumes 5 times more silver than it produces domestically. We're import-dependent, reliant on Mexico, Peru, global supply chains, and China is currently buying out that global market with 29% premiums. Rubio understands that if this continues, if COMEX runs dry by March, as the math suggests, the U.S. military-industrial complex faces material shortages. Lockheed Martin calls the Pentagon explaining they cannot manufacture guidance systems because they cannot source silver paste. That's a national security nightmare. So tomorrow's meeting isn't a trade summit, it's a war council. They'll attempt to strong-arm allies, draft agreements restricting critical mineral exports to non-market economies, meaning China. They'll try to ban the arbitrage trade. They might even propose capital controls on strategic metals. You cannot ship silver to Shanghai because it's a national defense issue. But there's a fundamental problem. You cannot legislate away economic laws. You cannot stop water flow with paperwork. As long as Shanghai prices are $36 higher than New York prices, metal will find a way. Smugglers will move it. Third-party nations will buy from the U.S. and resell to China. Black markets will fill gaps. The only way to stop the drain is for Western prices to rise. New York must match Shanghai. The $86 suppression scheme must end. The U.S. must let silver reach 120 just to keep it inside the country. This meeting is an admission of defeat. The U.S. government admitting that the free market they claim to champion is currently destroying them because they manipulated prices too low for too long. They suppressed the beach ball underwater. Now it's popping up and hitting them in the face. Rubio is trying to hold it down with executive orders. It won't work, and markets know it won't work. That's why, despite yesterday's paper smash, prices are already recovering. That's why psychology hasn't broken. Traders see the desperation in D.C. and smell blood. When governments start holding emergency meetings about supply chains, it means the cupboard is bare. And look at price action today. Yesterday, they threw everything at the market. Kevin Warsh announcement, deflation narrative, billions in paper shorts driving silver to 83, shock and awe designed to break confidence and force capitulation. Usually after such violent moves, markets stay down for weeks. But look at screens today. It's Tuesday. Where's the price? Languishing at 83? Crashing further? No. Silver ripped back above 86. Gold jumped above 4,900. The worst crash lasted less than 24 hours. They fired their biggest weapon. The market shrugged it off and kept climbing. This is massive psychological confirmation. Dip buyers are now stronger than paper sellers. The market realized the truth. The crash was manufactured. Traders looked at Shanghai prices, which never crashed, and understood the New York drop was a gift. They saw the $34 arbitrage gap and realized silver at 83 was catastrophically mispriced. So they bought aggressively. This is the definition of failed suppression. And in technical analysis, failed moves lead to fast moves in the opposite direction. When you try holding a beach ball underwater and lose your grip, it doesn't float up gently. It rockets out of the water. We're witnessing the rocket phase. The shorts who sold yesterday hoping to drive prices to 70 are now trapped. They sold at the bottom. Price is back at 86. They're underwater. And as price ticks higher to 90, to 100, they'll be forced to cover, forced to become buyers. This is fuel for a short squeeze. The worst shock was supposed to kill the bull market. Instead, it confirmed it. It proved that even with the entire weight of the U.S. government and banking cartel pushing down, they cannot keep silver below 85 for more than a day. That's a hard floor, concrete support. And if 85 is the floor, then the ceiling is determined by the arbitrage gap. The ceiling is 120. The ceiling is wherever Shanghai is trading. Think about the physical reality supporting this bounce. While paper prices fluctuated violently, the physical market in Shanghai kept grinding higher. Chinese buyers don't watch CNBC. They don't care about Kevin Warsh. They care about securing metal. And volume on the Shanghai Gold Exchange is exploding. They're draining the world. And Western prices must rise to catch up. The arbitrage vacuum guarantees it. Unless New York silver reaches 120, metal will keep leaving. So the price rise isn't speculation. It's necessity. The only way to stop the bleeding. U.S. banks will eventually have to go long. They'll have to let price run just to prevent COMEX from defaulting. So the attempt to save the dollar backfired spectacularly. They tried making the dollar look strong by smashing gold. But gold bounced. And now the dollar looks weaker than ever because it couldn't suppress metal for even one full session. The emperor has no clothes, the Fed has no bullets, and the cartel has no silver. This sets the stage for the final act. We have the signal from Xi Jinping, we have the vacuum-sucking metal to China, we have panic in the U.S. State Department, and now we have price recovery confirming the trend. The board is set for checkmate. Here's the verdict. We've connected the dots. Signal from President Xi calling for a powerful currency backed by gold pricing dominance. The vacuum created by $34 arbitrage draining the West. Panic in Washington as Rubio tries building metal NATO to stop hemorrhaging. And price recovery back above 86 proving market psychology is unbreakable. The conclusion is clear and terrifying for dollar holders. The United States played its final card yesterday, used the worst narrative and massive paper dump trying to break the silver market, wanted to scare you, crush prices, save the dollar, but all they accomplished was putting the world's most strategic asset on clearance sale for their enemies. The U.S. smashed paper prices. China said thank you and backed up the trucks to buy the physical dip. Now vaults in New York and London are emptying at record speed. The river of silver flows east and never returns. The State Department holds emergency meetings because they know what comes next. By March, if this flow continues, COMEX will be a hollow shell. Pax Silica, American dominance of the technology supply chain, is dead. The price of silver in the West has only two destinations. Option 1, it goes to zero because there's no metal left to trade. Option 2, it goes to 120 to match Shanghai. The $34 gap is a law of nature. It must close. And it won't close by Shanghai coming down. It will close by New York going up. The suppression has failed. The dam is breaking. The worst crash gave you a brief window to buy silver at a discount subsidized by central planner stupidity. Don't waste it. Don't let volatility shake you out. The squeeze isn't over. It's just beginning. The financial military parade is about to start, and you want to be holding the assets sitting on the lead float. Ignore the paper. Trust the flow. The East is buying, the West is panicking, the price is rising, the arbitrage gap guarantees it, the vault drain proves it, Xi Jinping's article confirms it. The global gold final battle isn't coming, it's already here. The question is whether you're positioned for what happens when the world realizes the largest holder of U.S. debt is systematically exiting dollars while accumulating the one asset that can't be printed, sanctioned, or frozen, the asset they're paying $34 per ounce premium to secure, the asset that's flowing east and never coming back. Game over, buy the dip. OG John signing off.